Well, you've heard of BYD, but have you heard of Wuling? GM's Wuling, a joint venture between GM and SAIC, has now announced a $7,900 car in China. You know, again, all roads lead to natural resources over here. And hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. And no, that's not a typo. This is Peter Johnson, courtesy of Electric, who has been doing an outstanding job following the electric vehicle narrative. GM's Wuling launches new $8,000 bingo EV in China, undercutting BYD's Seagull. GM's joint venture with SAIC, Wuling, launched the new 2024 bingo EV Friday with new upgrades and a lower price tag. With starting prices under $8,000, GM's new Wuling bingo undercuts BYD's Seagull. BYD's Seagull EV was the top-selling small car in China last month. To bump up sales in hopes of overtaking BYD's Seagull, the 2024 bingo includes faster charging, new features, and a starting price of $7,900. So the price war continues. I feel like I'm talking about Walmart here. You know, why pay more? Nobody should be surprised that a $9,700 vehicle was the biggest selling car in China last month. And they're actually making pretty big inroads in Germany, interestingly, until these tariffs come in. I just read a report here, courtesy of Electric as well. Chinese electric vehicle imports in Germany, 40% are BYD, which seems to be remarkable on its own. So what can we conclude then from this $7,900 vehicle by GM? First of all, it's an open question if they're making money on this. You know, to use a retail term, is this a loss leader? Is GM, under the guise of Wuling, are they taking a page out of China's playbook, which is don't worry about making money, just get market share? Just the fact that they can even attempt this game shows how important it is, I would argue, of being close to the supply chain. I mean, how much does it cost to send metal from China or Indonesia, let's say, to North America, you know, to be manufactured? Like, surely there's a cost there. So it's not just about being able to process the metals at the cheapest rate. To me, what this shows is this isn't a matter of, you know, BYD necessarily being the greatest company. And who knows, maybe they are. But I think with this story from GM, what we learn is how important it is to be close to the supply chain. The only non-negotiable in your manufacturing of automobiles is the metal. Theoretically, in a war for your own existence, you go, okay, theoretically, the workers can be replaced with machines. It's not fun to think about. There's already been a lot of talk about this. Sooner or later, one could imagine robots are going to be running these factories over humans. Theoretically, that is a point of savings. If you're in a war for your existence, perhaps that's a road that you're considering at some point here. That's a negotiable, something that you can, you know, theoretically innovate your way around. I'd argue what's non-negotiable are the metals, the components. You have to make this car out of aluminum, out of copper, out of nickel, out of lithium, out of, you know, rare earths, and on you can go. That stuff has a cost. And it seems to me the closer you are to the supply chain, to these metals that are being processed, the better off you're going to be. I think that's one of the lessons it's tempting to conclude from this situation. It's not a matter of, is this company simply copying us and doing it better? It's a matter of cost of the components. That's what GM is showing us here, I would argue. Again, are they making money on this? Hard to say. I mean, we're in a price war is what this looks like to me. And maybe one day over in North America and the EU, maybe one day we'll get to take advantage of this price war. In the meantime, we're looking at much higher costs for vehicles. So, interesting development on the EV front. And just to bring us up to date, the EU announced tariffs on June 12th between 17 and 38% on vehicles coming out of China. And that includes companies like Tesla, right? So again, we're kind of back to this idea. It's where it's being produced that they're able to make things at such a low cost. That is the thing that you almost can't tariff your way out of. Because sure, EU and the US can put tariffs to, protect their auto industries, even though the Germans are protesting. They don't want any part of these tariffs, interestingly. They have a lot to lose here. Nevertheless, the EU has announced these tariffs are going to last for 4 months, according to the AP. So it all goes to show that these aren't about companies. This is about the supply chain. I think that's what we can learn. The companies want to go to where it's cheapest to make their cars, and right now, that's China. End of story, right? So very interesting developments there. Again, a $7,900 vehicle from Wuling, which is a JV between GM and SAIC. So just to tie the bow on the tariff discussion, of course, China responded to the EU announced tariffs. And it says here, this is the AP, China targets Europe's farmers and not its automakers in response to EU tariffs on electric cars. This is, again, the Associated Press in Beijing. The Chinese government is taking aim at European farmers instead of German automakers by launching an investigation into European Union pork imports, just days after the EU said it plans to impose provisional tariffs on China-made electric vehicles. The Commerce Ministry didn't mention the EV tariffs when it announced Monday that it is opening an anti-dumping investigation into pork from Europe, but the move is widely seen as a response to the EU move on electric cars. It also gives China a bargaining chip in any trade negotiations. So it's interesting. The German auto industry, as well as Scholz himself, have come out and said they don't want these EU car tariffs, interestingly. And this is Reuters on June 14th. Chancellor Olaf Scholz's government is pushing for what it calls an amicable solution after the European Union threatened to impose anti-subsidy tariffs to shield European automakers from competition. As Europe's largest automaker, Germany's voice carries particular weight, and its leading car manufacturers have vociferously opposed the EU tariffs, fearing retaliatory measures could harm business in the vast Chinese market. And we have a quote from a spokesperson. Quote, "It would be very desirable to come to an amicable solution, but it is also clear that serious movement is needed on the Chinese side," end quote. And we have a quote from Volker Wissing, the transport minister in the German government, who said, quote, "Nobody wants a trade war with China. It would be a catastrophe for Germany, and it would not be beneficial for the European Union either," end quote. He told the DPA news agency in an interview quoted by the Tagesspiegel newspaper. So perhaps with Germany speaking against these tariffs, maybe that is why China has not targeted German auto manufacturers, but has instead targeted agricultural products. So kind of an interesting move there. From a game theory perspective, maybe China sees a little bit of an opportunity to split Germany from the EU a little bit. So that is interesting. Now, one more issue I want to bring up here are these Sprott physical commodity funds. We saw that there was the uranium. I mean, don't forget, for longtime listeners here, we talked to Rohan Reddy several times with Global X ETFs, and he was mentioning how really the big, shift in the uranium market when it really started to move was when Sprott launched its uranium fund. Now they're talking about a physical copper fund. Interestingly, Javier Blas at Bloomberg wrote a column speaking against this whole notion, and I've been mentioning it here as well. Like, if you're the government, do you really want there to be a physical fund for uranium? I mean, the theoretic idea from a market perspective is, oh, this increases liquidity. We get to a closer price of real uranium, right? This is, I think, the free market view on it is, if it gets too expensive, then other people will come into the market and sell. But it's always in this idea that we have unlimited amounts of resources. But is there an unlimited amount of uranium? Everything I hear is that we're very limited. And if people are just going to, as Javier Blas puts it, hoard the metal, do governments really want this? Put it this way. It seems to me if you're the government and you hear that the Sprott Commodity Fund in Canada is starting to lift the uranium market, and all of a sudden you have a potential issue and you're facing down Russia geopolitically, and you're wondering where your uranium is going to come from to power your nuclear power grid, do you really want these guys messing around, creating some physical commodity fund? As I was mentioning on a previous episode, I think this kind of flew under the radar. I think the Canadian authorities basically thought, well, no big deal, and we'll let this uranium fund. But really what's happened is, again, it's tempting to see a direct causal relation there. Now, Javier Blas is arguing in Bloomberg that this should not be allowed with the Copper Fund. And here's the headline, an opinion piece by columnist Javier Blas at Bloomberg.com. Don't legitimize cornering the copper market. Regulators should be wary of physical commodity funds that can sap supply. And here is just a few paragraphs. When the Hunt brothers cornered the silver market in 1980 by amassing a huge cache of the precious metal, jeweler Tiffany & Co. ran an advertisement in the New York Times denouncing the move. Quote, "We think it is unconscionable for anyone to hoard several billion, yes, $1 billion worth of silver and thus drive the price up." End quote. Might the copper market suffer a similar squeeze? Until now, I would have been confident in saying no. But speculators are about to get an easy and completely legal way to dominate the market for the red metal, a development that regulators seem far too relaxed about. Sprott Inc., a Canadian firm, has launched a $100 million fund that will buy and hold physical copper on behalf of investors. Unlike most other speculative products set by financial derivatives, such as futures contracts, the new vehicle will purchase actual metal stored in a warehouse. Copper doesn't have the luster of silver or gold, but it's crucial for the global economy, particularly as the electrification of everything makes copper more essential. A copper squeeze would be therefore detrimental for global economic growth and inflation. Consumers, think about wire companies that produce electric cables, electric car manufacturers, and air conditioner makers, should be alarmed. And again, all roads lead to natural resources. A decade ago, when JP Morgan Chase and BlackRock proposed similar products, U.S. copper users went to court to block them. Both firms ultimately abandoned their projects. I think, again, my theory on this whole Sprott thing is it's flying under the radar through the Canadian markets. The new fund, listed on the Toronto Stock Exchange, has started with a small cache, fewer than 10,000 metric tons of copper, a fraction of the 28 million tons consumed annually. But its stockpile already equals more than 50% of the stocks in warehouses linked to the copper futures contract listed in New York, and about 10% of the stocks linked to the contract listed in London. The recipe for disaster is simple. As more money pours into the new fund, more copper will need to be stockpiled as backing. Other firms are likely to follow with their own physical funds, boosting demand even further. Rinse and repeat, and the copper market could suddenly face an acute and artificial shortage. We're already facing a pretty big shortage here in the mid to long term. Do we need investors and speculators stockpiling metal? Is that really creating liquidity in the markets? Are we really getting to a closer, more accurate price? I mean, that's the theory that I think the free market people would say. I'm just not sure, again, if we just let everything run amok, I'm not sure that's going to work out. Let's continue. Canadian regulators may have decided that the new copper fund wouldn't impact today's market prices. While that's currently true, they've opened a dangerous door that will be difficult to close in the future if physical copper funds become sufficiently popular to squeeze the market. Granted, the metal will be there, stored in warehouses, and in theory accessible to whoever needs it. But if investors refuse to sell, it won't be available to the global economy, which could lead to wild price swings. That regulators have opted to legalize this kind of squeeze doesn't make it less dangerous. Investors looking to speculate in copper had plenty of other instruments available, including swaps, futures, and options. And finally, I'm all for encouraging speculation in commodity markets. Hot money plays a key role in helping to guide the invisible hand, providing price discovery and liquidity. But the Sprott Physical Copper Fund isn't a speculative investment vehicle. It's a hoarding one. The fund manager is in the buy and hold commodity business and makes no secret that its model relies on stockpiling. Its strategy is to never sell the copper it accumulates, barring very unusual circumstances, although it would be open to loaning the metal. Finally, if Sprott succeeds to the point where it attracts, say, a couple of $1 billion in assets, the fund would need, at current prices, about 200,000 tons, surpassing the amount of copper available in the warehouses linked to the copper contracts in London and New York. So more skepticism on these Sprott physical commodity funds. It's going to be interesting to see if governments are going to keep tolerating this. I just think they're probably not aware of it. Governments are starting to attend these mining conferences, as we saw with PDAC. The Northern Miner just had a conference, a collaboration in Washington. Policymakers are starting to attend these conferences, so it seems to me it's a matter of time before they discover what's happening with the Sprott uranium and potentially copper fund. I'm not convinced these are not going to be regulated away at a certain point. So a wonderful episode ahead with all sorts of technological innovation. We have Mariem Akrout of AI Energy talking about the latest developments in AI and how it can apply in a very practical way to the natural resources sectors, particularly mining and energy, how companies can actually begin the process of trying to figure out how to implement AI in their organization. How should they be thinking of it? So a great interview there with Mariem Akrout, CEO of AI Energy. And also coming up, we have Adrian Dance from SRK, who discusses a methodology that SRK has been working on, an approach to processing ore in a more efficient way, getting rid of everything that shouldn't be there. And the latest developments, the tools, the approach, and everything. So that is coming up on this week's CEO Spotlight. So lots to look forward to. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Adrian Dance of SRK Consulting for this week's CEO Spotlight. Joining us today, I'm very pleased to welcome back to the Northern Miner podcast for this week's CEO Spotlight, Adrian Dance, Principal Consultant of Metallurgy in the Vancouver SRK Consulting Office. Adrian, welcome to the show.
Yes, thank you, Adrian. It's very good to be here. Good to talk to you again after a couple of years.
It really is, as you're mentioning before the show, is back in 2022 that we last talked. So, of course, I'm familiar with SRK Consulting. I think most people in the industry are familiar with SRK as well. But for those who aren't, who may be listening, maybe investors, students, and anyone else, just tell us a quick description of what SRK is and what they are up to.
Absolutely, Adrian. So SRK Consulting is a global consulting services company celebrating its 50th anniversary. It specializes in all different types of disciplines in the mineral space mining industry, from exploration, resources, geology, mine planning, optimization, metallurgy, my own discipline, all the way through to environmental protection and geoenvironmental and final closure. So we cover all aspects of the mining industry, from early projects to existing operations.
Okay, excellent. So a real comprehensive approach here from SRK towards the resource industry. So today you're here to discuss an approach that you have towards really processing materials and something that SRK can offer miners that are processing material, which might lead to, let's say, more efficiency. I'll let you describe it. What are you working on?
Well, thank you. So first of all, I want to acknowledge my colleague, Bob McCarthy, a principal mining engineer here also in Vancouver, who has been working with me for the last few years. And those who are following me on LinkedIn or SRK's page know we've been talking about this. But SRK is becoming very passionate as a thought leader in the area of pre-concentration. And to us, that means looking at the material that's going to the process plant very early on, before it's highly crushed and ground and water and energy is being consumed. And the things we're looking into is whether or not that ore can be improved in its quality. Can we reject material that shouldn't be there? Can we improve it in grade and composition, and even reject some deleterious elements? And very often that involves two different types of sorting, either bulk sorting, where we look at all the material, or particle sorting, where we look at the individual particles themselves. And there's pros and cons to both approaches. And so what we're looking at is a kind of systematic methodology to evaluate every property, either a new project or existing operation, and whether or not it could benefit from looking at coarse beneficiation or pre-concentration.
Okay, excellent. So you have an approach in order to really render this processing of material. It sounds like actually getting rid of things that shouldn't be there and not processing.
Exactly.
Right? So saving energy, time, and everything.
And reducing the amount of material going to the tailings pond, which of course everybody wants, and that makes so much sense.
Another benefit here. So there's also an environmental benefit. So
absolutely.
And so there's a methodology, as you say. Describe for us then, what's the physicality of this? Like, how does this work? It sounds like there's a tool that you have with x-rays. Like, describe like how this works in a practical sense.
Absolutely. So it's a multi-phase project approach where we first look at the geology and the deposit itself, and we assess whether or not heterogeneity or the variation in grade is something that potentially can be exploited. So we do a desktop review of the property before we even get to the testing phase and see whether or not the economics support the idea that pre-concentration might work. And we have a phase, what we call size the prize, where we look at the potential to improve the economics and whether or not this is even feasible. So this is relatively low risk. It's relatively low cost. It's something we're doing a lot of on a variety of parts of the industry. And this is even before we talk about getting samples for testing. The next phase, should the economics prove that, is we can take samples and evaluate whether the material can be separated. And we do that by looking at how the material breaks, how it presents itself at a coarse size. And part of that is the existence of the laboratory unit that we have at Base Metallurgical Labs here in Western Canada in Kamloops, BC, where SRK is co-owners of a lab scale X-ray transmissive or XRT sensor evaluation unit, which is something that's novel. And it's in the hands of a commercial metallurgical laboratory being run by independent people, being reviewed by SRK, which prides itself on its independence and, in fact, is being referred to as being vendor agnostic, which is something I think the industry really would benefit from.
It sounds very promising. So, again, getting down to brass tacks, let's say I'm a mining company. How do I know if this is worthwhile? Like, in a sense, like, what is the process for me? If I listen to this interview and say, this makes sense to me, maybe this can benefit me, like, what is the process?
Well, very good. So as we deal with all of our clients, they approach us and say, this is the scope of work we're interested in. If they're not clear themselves, a couple of quick conversations with us would outline a project. But again, every property has a database of their drill hole data. This is even a state where maybe the property doesn't even have an evaluated resource or an estimation of resources. This can happen very early. And one of our features of our method in terms of testing is we do it on existing drill core samples. So we don't require any onerous large masses or any particular sampling. We work within the constraints that we know exist in the industry. And we know everybody has drill hole assays. We know everybody has access to half core samples, and we focus on doing small mass, large number of tests that can be done to really improve the confidence. As opposed to a single large composite sample, we can test small mass and get a lot of really good information on how this could potentially benefit a project or an operation.
Interesting. So in a sense, rather than, a high cost, heavy, sending all these, massive amounts of samples, a bulk sample, I suppose you would call it,
Yes.
to the laboratory, in a sense, you're saying you don't need to do that. You can do it with smaller samples from drill core even, and you can start to determine if this is worthwhile for the company.
Exactly. And so the whole idea was that if you're sending samples for metallurgical evaluation, you can add our protocol to it with zero disruption and get information on whether pre-concentration works for your property. Similarly, the fact that we have this machine that can reproduce what it's doing, we can generate concentrated samples for downstream testing. But the focus of our work is very much on what we can do within the existing sample requirements and having it done repeatedly following a consistent and standard protocol at an independent lab, which is how all of our other metallurgical testing has been done for decades now.
Well, I mean, this is fascinating. And as you say, it could be beneficial on several levels. So if I want to act on this, then what is the process? Do I go to the website? Do I find you on LinkedIn? What should I do?
Great question. The reason we're here. So we're advocating that companies contact us with any level of interest. We're getting quite a lot of inquiries right now, but we do have capacity in the lab to handle more samples. And by the way, we're not only looking at new projects, but we're looking at existing properties where they have, say, low-grade stockpiles. We can look at samples from those low-grade stockpiles. Can we upgrade them? We're also looking at an interesting area that I want to make sure I mention, which is the pebbles that come out of our grinding mills. we are getting some absolutely fascinating results that I'll be presenting at next year's CMP conference on how we're looking at pebbles and the potential to reject hard material coming out of our mills. But to contact us, you can get a hold of us through SRK's website, where we have a lot of other material and videos and resources available on this particular area. And you can contact me, of course, on LinkedIn, which I'm trying to post relatively regularly on the benefits and also the results that we are doing on the testing.
Okay, excellent. I will post your LinkedIn details and whatever links you have in the show notes, but just audio-wise, if someone's listening, should they just look up Adrian Dance on LinkedIn?
Yes, srk.com is our main website, North America, and certainly under our services for metallurgy, we have a whole section on pre-concentration, which includes videos by myself and Bob McCarthy. We've got a number of video series under there, articles, as well as LinkedIn posts are duplicated there. But yes, that's the best resource, srk.com.
Adrian Dance, Principal Consultant of Metallurgy at the Vancouver SRK Consulting Office. Thank you for joining us and sharing this very interesting methodology and technology on this week's CEO Spotlight.
Very good.
And thank you once again to SRK Consulting for sponsoring this week's episode of the Northern Miner podcast. To learn more, you simply go to the contact page on srk.com. Turning to the website, Ottawa diverts $3 million rare earth sale from Chinese firm in case of elevated interest for Canada. This is Blair McBride at the Northern Miner. The federal government has brokered the sale of $3 million in stockpiled rare earths mined in the Northwest Territories by Vital Metals, the company said on Monday, as Canada moves to keep its critical minerals out of Chinese hands. Natural Resources Canada organized the sale of the rare earths mined at Vital's Nekalako project to the Saskatchewan Research Council, a Treasury Board Crown corporation overseen by the provincial government. It replaces a sale last December of $2.3 million Canadian worth of stockpiled rare earths mined at Nekalako to Chinese firm Shenghe Resources. Shenghe earned a 9.9% stake last October in the Australian company. So, pretty interesting. Shenghe owns 10% of the company, and now Ottawa has diverted those rare earths that have been stockpiled in Northwest Territories over to Saskatchewan. And here's a quote from Vital Managing Director Jordy Mark, who told the Northern Miner on the phone, quote, "We were presented with a case of elevated interest for Canada," end quote, though he declined to discuss details of government involvement in the sale. Jordy Mark also said, quote, "This agreement highlights the strategic value and importance of the Nekalako rare earths project and the prioritization of a rare earths value chain in Canada. This sale is also beneficial in deriving value from our work at Nekalako as we continue to advance the Tardif rare earths deposit as a long-life, large-scale project with a scoping study to examine potential size and scalability of Tardif on track for delivery by the end of 2024. Finally, the stockpile sale last December raised eyebrows, with some saying it highlights the lack of investment by Canada in critical minerals projects. But the stockpile has never left Saskatoon, Saskatchewan, and Vital hadn't bought back the rare earths from Shenghe because money in the deal had not yet exchanged hands, Mark said. Quote, "Normally with overseas sales, you get paid once it's on the ship," end quote. He said, adding the transaction doesn't change Shenghe's 9.9% stake in Vital. So it sounds like it was allocated to Shenghe, but the Canadian government stopped it. So pretty interesting development there. Another rare earth story, Brazil joins race to loosen China's grip on rare earths industry. This is Reuters via mining.com. Mining giant Brazil has big ambitions to build a rare earths industry as Western economies push to secure the metals needed for magnets used in green energy and defense and break China's dominance of the supply chain. Working to its advantage are low labor costs, clean energy, established regulations, and proximity to end markets, including Latin America's first magnet plant, which would provide a ready buyer for the metals. But low rare earth prices, technical challenges, and nervous lenders pose challenges to the Latin American nation's hopes to propel itself into the world's top 5 rare earths producers. Well, as they say, rare earths aren't particularly rare. It really comes down to the processing. So that's really probably where the test is going to come. Brazil holds the world's 3rd largest rare earths reserves. The country's first rare earths mine, Serra Verde, started commercial production this year. And we have a quote from Daniel Morgan. Output is set to grow, analysts, mining CEOs, and investors say, supported by Western governments' incentives that are also accelerating a global rare earths refining and processing industry. And we have a quote from Daniel Morgan of Barrenjoey Investment Bank in Sydney. Quote, Brazil as a source of potential rare earths is a very exciting proposition because there have been very meaningful discoveries made in the last couple of years. I do think outside of China, Brazil's projects are the most economic greenfield projects available, end quote. Very interesting. And continuing on, Chinese Premier's Western Australia tour spotlights global race for critical minerals. And this is Reuters via mining.com. Chinese Premier Li Qiang visited a lithium processing plant in resource-rich Western Australia state on Tuesday, highlighting China's push to secure critical minerals as Washington tries to break Beijing's supply dominance. Western Australia supplies more than half of the world's seaborne iron ore, with China its top customer, and half of its lithium used in electric vehicles, smartphones, and other electronic devices. Li's visit to Australia, which began Sunday, is the first by a Chinese premier in 7 years and marks a stabilization in ties between the U.S. ally and the world's second biggest economy. While China has largely lifted suspensions imposed on $20 billion worth of Australian exports in 2020, after Canberra sought an investigation into the origins of COVID-19, it continues to express concerns about obstacles to Chinese investment in Australia's vast resource industry. And Albanese is quoted as saying, quote, our commitment to investing in local manufacturing doesn't mean cutting trade ties or pulling up the economic drawbridge. Far from it. International partnerships and the inflow of foreign investment will continue to be crucial for Australia as we modernize and diversify our economy, even as we take steps to secure our economic sovereignty and build resilience in sectors that are vital to our national interest, end quote. So Australia having to balance between China being a major customer not too far away and its traditional interests in the West. Very interesting. Continuing on the electric vehicle front, South Korea, Kazakhstan signed minerals deal as Seoul moves to diversify supply chain. This is Reuters via mining.com. South Korea has struck deals with Kazakhstan to allow its firms to explore for more critical minerals in the Central Asian state, it said on Wednesday, as the home to major chip producers and leading car maker Hyundai moves to diversify its supply chains. South Korean President Yoon Suk-yeol is on a state visit to Kazakhstan following a similar trip to Turkmenistan this week ahead of a visit to Uzbekistan. Wednesday's Memorandum of Understanding on Critical Minerals Supply Chains will allow South Korean companies to take part in exploration for lithium, chrome, uranium, and rare earths development, the industry minister said. South Korea is home to semiconductor producers and the world's fifth largest automaker, Hyundai Motor Group, which is making a push for electrification. Stable supply of critical minerals is considered crucial as the country lacks natural resources and is one of the world's largest energy buyers. And a very interesting quote here from Yoon, who said at the press conference that the deal had been struck, quote, as we pursue becoming a global pivotal state, end quote. Using seemingly Zbigniew Brzezinski's language there of being a geographical pivot in the grand chessboard, pivots being, geopolitically important states. So quite interesting language from the South Korean president. Continuing on, we have another story with Hyundai and Kia, both Korean car makers. SQM reaches supply deal with Hyundai and Kia. This is Reuters via mining.com. So Korea out there now making natural resource deals. Chilean lithium miner SQM, the world's second largest lithium producer, said on Monday it had reached a long-term supply deal with Hyundai and Kia to provide the car makers with the white metal key for the production of electric vehicle batteries. And this is Reuters via mining.com. Hyundai and Kia will, quote, secure a portion of their future lithium hydroxide supply from SQM, end quote. SQM did not give financial details of the deal with the Korean automakers, but said there was, quote, strong motivation to continue with its lithium hydroxide expansion plan, end quote. And something I didn't mention in the previous article on Korea and Kazakhstan, that earlier this month, South Korea hosted its first summit with the leaders of 48 African nations looking to tap the continent's mineral resources and potential as an export market. So working all across the globe, it seems South Korea is very intent on securing its supply chain. and making deals. Quite interesting. Continuing on, Serbia to give green light for Rio Tinto's lithium mine. And this is Reuters via mining.com. Rio Tinto's Jadar project. There were protests in 2021 and 2022. Serbian President Aleksandar Vučić is preparing to give Rio Tinto the green light to develop Europe's largest lithium mine 2 years after Belgrade called off the project, the Financial Times said on Sunday. So, pretty interesting development there. Now, we see all of this, clamoring to secure the lithium supply, but wait till you see the story from Bloomberg NEF that said the world needs more batteries, but not this many. Bloomberg News via mining.com. So are we heading into overproduction of batteries? So here's the story. The wave of battery factories under construction around the world will be able to produce far more cells than the global economy needs, Bloomberg NEF warns in a new report. Demand for lithium-ion cells is growing fast as automakers electrify their fleets and utilities install big batteries to stabilize the power grid. But manufacturers have announced so many new factories that capacity will outstrip demand for the rest of the decade, according to BNEF. By the end of 2025, next year, the global battery industry will be able to produce more than 5 times as many cells as the world will need that year, Bloomberg NEF forecast in its latest electric vehicle outlook. Quote, "This is good news for automakers and EV buyers, but marks a challenging time ahead for new entrants to the battery industry," end quote. Oversupply is most acute in China, where manufacturing capacity will exceed annual battery demand by at least 400% for the rest of the decade. It's also an issue in the U.S., where President Joe Biden has made building a domestic battery supply chain one of his top climate and industrial priorities. Among efforts to woo battery makers, the administration offered a conditional $9.2 billion loan to Ford Motor Company last year to construct 3 battery factories. Europe also faces a glut of battery capacity, yet governments are pushing for more. Swedish battery maker Norvolt AB has a plant under construction in Germany, but the country's economy minister Robert Habeck is already lobbying the company to build another. Some planned factories around the world may be delayed or canceled due to the industry's overcapacity, according to Yayoi Sekini, head of energy storage research at Bloomberg NEF. Ford, for example, has ratcheted back its plans for ramping up electric vehicle production, citing a price war for battery-powered cars and trucks. Quote, "This will be a problem everywhere, including the U.S., end quote, she said in an email. At the same time, chemistries used to make batteries are changing. The report found that lithium iron phosphate batteries are gaining popularity for powering electric cars. So that's lithium iron phosphate batteries, particularly among Chinese automakers. Their component materials are cheaper than the standard lithium-ion cells that use nickel, manganese, and cobalt, and the shift could substantially lower future demand for those metals. Bloomberg NEF cut its forecast for the amount of nickel used in batteries next year by 25%. So, interesting there. Just a few headlines here. Copper price slides to 8-week low after more soft data from China. That's Bloomberg News via mining.com. Another headline. Iron ore price falls for a 3rd week on China demand woes. This is Reuters via mining.com. So China really a massive influence on the base metals market. Another headline, this is Bloomberg News via mining.com. China's hydropower surge raises aluminum production to a record. And another headline in the opposite direction here. Global nickel prices have probably hit a floor, says Macquarie. This is Reuters via mining.com. And here is Macquarie analyst Jim Lennon, who told a conference organized by Shanghai Metals Markets in Jakarta, quote, "Our belief is that we've seen the bottom. We've seen the supply adjustments, we've seen the uncertainty in future supply, and that has given us quite a lot of support where the prices are today," end quote. So Macquarie's seen a bottom in the nickel market. And finally, the World Gold Council has done a survey, and more central banks are going to increase their gold reserves within the next 12 months. And here's a quote from Shoukei Fan, WGC head of central bank sector, who said in a statement, quote, "Despite record demand from the official sector in the last 2 years, coupled with climbing gold prices, many reserve managers still maintain their enthusiasm for gold," end quote. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market. For context, the U.S. 10-year bond is yielding 4.23%. That is 0.22% lower than last week. The UK 10-year gilt is yielding 4.04%. That is 0.24% lower than last week. And the Italy 10-year bond is yielding 3.89%. So back below 4%, and that is down 0.18% from last week. So 10-year bonds all moving lower. Turning to precious metals, gold is trading at $2,344.20 per ounce. That is $16 higher than last week. Silver is trading at $29.57 per ounce. That is 36 cents higher than last week. Platinum is trading at $977.70 per ounce. That is 50 cents higher than last week, so almost unchanged. Palladium is trading at $880.50 per ounce. That is $11 lower than last week. Turning to industrial metals, copper continues to move lower at $4.49 per pound. That is 6 cents lower than last week. Iron ore is trading at $107.05 per metric ton. That is $1 lower than last week. Aluminum is also lower at $1.13 per pound. That is 4 cents lower than last week. Lead is unchanged at $1 per pound. Nickel is trading at $7.86 per pound. That is 35 cents lower than last week and back below $8 again. Tin is trading at $14.58 per pound. That is 31 cents higher than last week. So tin doing well, upsetting the trend here. Cobalt is unchanged at $12.32 per pound. Lithium is falling through the floor at $13.30 per kilogram. That is 70 cents lower than last week. The lowest we've seen here in the last 6 months since we started covering lithium was $13.27. So flirting with a midterm low here at $13.30 per kilogram. Uranium is at $86.15 per pound. That is $1 lower than last week. And zinc is unchanged at $1.29 per pound. Zooming out, the metals continue to correct. A lot of concern of demand out of China, while tin upsets the trend, moving higher. So more strength in the tin market, with zinc unchanged, not doing too bad either. And those are your metal prices. Coming up, I'm very pleased to welcome to the show Mariem Akrout, CEO of AI Energy. It is a wide-ranging discussion on how AI is transforming the mining industry and also how miners can prepare for a technology, as Mariem puts it, that could be as big as the internet and how it transforms how we work. So something that simply has to be dealt with and you have to educate yourself on. So we're going to do a little bit of that here with Mariem Akrout, CEO of AI Energy. I hope you enjoy the discussion, and I will see you on the other side. Joining us today, I'm very pleased to welcome for the first time to the Northern Miner podcast, Mariem Akrout, CEO of AI Energy. Mariem, welcome to the show.
Hi, Adrian. How are you?
I'm doing wonderful, and I'm just thrilled to have someone on who can talk about artificial intelligence, because, of course, it is one of the big themes, I'd say, of the last year. But when it comes to how it relates to the mining industry and how to implement it, and how it changes things, a lot of people have a lot of questions. So I'm thrilled to have you on. So before we get started, you are, again, CEO of AI Energy. So maybe tell us how you got involved in AI, what your company's about. What are you doing right now professionally in terms of AI and, say, the mining and the energy industries?
In terms of my background, I started as a project engineer 15 years ago with a major oil and gas company. And I have worked in capital projects ever since. So today I'm working with a brilliant team of industrial and AI engineers who have worked with oil and gas mining. And what the company does is it provides AI solutions for mining and oil and gas capital projects. What we do, Adrian, is very simple. We make sure that companies make the best use of their engineering skills in capital project environments. So if you are a top performing mining organization, You don't want your engineering resources to do non-value adding tasks. You want them instead to focus on problem solving skills, on their innovative skills, and more generally make the best use of their cognitive capabilities. And this is actually where we and our AI models actually came into picture.
Okay, excellent. And just before we get into more details on, say, how it can work in, say, the mining and the energy industries, what kind of adoption have you seen so far? Like, are these industries fast to adopt? Are they slow to adopt? How do you see adoption right now as far as AI in these resource industries?
So I see the adoption quite slow. The AI industry is going at a very, very rapid pace. And when you see the adoption on other industries, it is not going as fast, but we see a lot of applications being implemented right now. But when it comes to oil and gas, mining, and more broadly, the energy sector, we don't see it adopted that quickly.
Okay, excellent. Yeah, just curious, just to get a sense of what you're seeing there being an AI company. Now, as far as how it relates to mining, what can AI do? It sounded like you were mentioning that, one thing that you can help with is how, engineers are deployed. How does AI help in the mining industry? How can it benefit?
That's a great question. So AI is a technology that enables machines to mimic human intelligence and problem solving capabilities. And in order for this technology to do that, it uses statistical and mathematical models to predict the best possible outcome given a set of input data. So let's say, for instance, that you have a pump or a compressor within your plant and that you would like to increase its availability. So using statistical models that actually allow you to predict the failure of your pump or your compressor would allow you to schedule maintenance before the equipment actually breaks down. And this would reduce your cost, the associated cost of maintenance, and increase the overall availability of your plant. Now, trying to tie this back to the broader mining value chain and to answer your question, today we see a lot of AI use cases being implemented. So on the exploration side, for instance, several companies are applying AI both to improve the odds of surface strikes and also to detect underground ore bodies that are invisible with today's techniques. So what they do basically is they gather geological data, geochemical data, or geophysical data to train their AI models. And these models, once trained and tested, would be able to identify patterns that allow them to decide where to sink new mines. Another benefit can be to generate new leads for geologists in order to further investigate underexplored areas. So this is all actually very interesting for mining companies because it allows them to revalue data that they have been investing a lot of money to acquire and turning that into exploration opportunities. So that's on the exploration side. So on the development side, and this is the space we actually operate in, AI use cases are now improving the legendary three constraints of mining development projects, which are schedule, cost, and scope. So a study we shared a few months ago with the Ontario Society of Professional Engineers showed that using AI in capital projects can actually reduce project costs by 7 to 9% of their baseline budget. So consider, Adrian, a project that would be worth $1 billion. So this would equate to a cost saving of around $80 million, which is tremendous. So if we think of all the projects that couldn't get financing because of huge capital costs, making project cheaper to execute through AI would actually increase their likelihood of going beyond the final investment decisions all the way to execution. This is all to say that AI has a lot of potential across the mining value chain, and that the faster we adopt AI technology, the better we will get the benefits from using it.
It sounds like to me that the benefits of AI are kind of across the whole scope of the company in the sense that not only can you improve on the efficiency within of, like say processing, or it can also help improve your exploration outcomes and even perhaps even reevaluating to a certain degree deposits and what is there and what might be possible. Is that right?
Yeah, I totally agree with what you said. And 99% of mining exploration projects fail to turn into actual mines. So having AI technology identify trends within exploration data would actually allow you to increase the success rate of exploration projects. So yeah, from an exploration perspective, definitely using AI would allow you to make the best use of the money you have invested to acquire data. And from the development project perspective, as discussed, they are very costly and many fail to move beyond the final investment decision. So having AI technology significantly reduce the costs and accelerate the execution of the project can definitely support in moving these projects from feasibility studies to the execution phase.
So how does this work then? Do you ask the companies for, I guess, data, and then you start to process that data and you start to get outcomes that you can start to draw conclusions? Like, how does the process work if I were to, say, be a mining company? And what would I need to do? I assume I'd have to bring you some kind of data.
Yeah, that's correct. And data is actually what will fuel our AI models. So the way we start any project is basically to evaluate the current capabilities of the mining. So first assess the quality of data, the IT infrastructure readiness, and then see which areas can AI actually have the most impact within your organization. So that's the very first step. The second step is once we have a clear idea about those areas, we create what we call a roadmap for AI adoption, and we would start pilot projects. And these pilot projects are where we actually look at your engineering data, whether it is data sheets, specifications, company standards, etc., that allow our AI models to be able to identify trends and be able to help your engineers in their detailed engineering or procurement or construction or even commissioning and startup. That's the second step. And the third step is as we do that, we train mining companies, organizations to use these AI tools.
Okay, so this all sounds good. Now, just in terms of a concrete example, like, can you give us a concrete, specific example of how this might work or play out for a mining company?
Yeah, definitely. So I can give you the example of a use case that we have implemented in an EPC project with a mining company. We have actually accelerated the tendering process timeline by 70% of their current schedules. So what happened was that engineers within the mining company had to go through hundreds, sometimes thousands of documents in order to be able to compare their tender packages to whatever bids they are receiving from their prospective bidders. And what we have done was basically to make sure that tedious and repetitive work of going through hundreds and thousands of technical documentation is done through AI and redistribute engineers' workload in a way that they would rather focus on solving technical problems that they might have received from their prospective bidders rather than, again, going through those hundreds and thousands of documents. So the whole idea, as I said earlier, is basically to make sure that engineers focus on what they do best rather than having to go through repetitive work of looking at documentation, whether it is international standards or company specifications or project requirements. So that's one example. Another example is related to clarifications that some of our mining clients get from their vendors and subcontractors. Throughout a capital project, you receive a lot of clarifications on project requirements and project documentations that have been developed during the FEED, for example. And here what happens is that capital project engineers, whether they are in project management or discipline engineers, need to go through all engineering documentation in order to be able to extract the information they need and answer third parties. And this is where our second use case comes into picture, because it allows them to reduce that tedious time of going through a lot of documentation from days to just a few minutes, and have them focus on the upstream part to make sure that whatever clarifications they are getting are answered on time in order to prevent procurement delays or construction delays.
So just as we're starting to wrap up then, if you're a mining company, whether big or small, and you want to get started with AI, what steps should you take?
A lot of people think that getting started with AI has necessarily to go through coding or learning Python, or it very rarely has to be that way. So what I suggest to a lot of people is actually to start with the basics. So there are a lot of online courses out there that actually explain the basics of AI. And looking for these courses, attending webinars, and trying to apply whatever you learn from these webinars and courses would actually allow you to start applying it to your specific function, whether you are in exploration or development or field operations. So that's the very first step. The second step, which I think is very important, especially in the AI space, is that given that the technology is evolving very rapidly, staying informed with what's happening in the AI space, joining forums, being part of open source projects would actually allow you to stay informed with what's happening. And the third step is basically to gain practical experience from any open source project that you can find, or from small AI projects that are within your organizations. Because as AI technology evolves and as mining companies start adopting it, a lot of these projects will come your way. So just volunteer to gain that practical experience that allows you actually to even develop your own real world AI application to help you with your day-to-day work.
And as you say, a lot of the fuel for AI is data. So I assume you'd also want to start thinking about, things that you want to improve on, you probably want to have data on, right?
Yes, exactly. So there is, of course, the historical data that you can leverage for any of the AI applications you have. There is the new data that you would be generating in case you see that whatever you are trying to achieve cannot be done with your historical data. So generating this data will actually allow you to close the gap and give your AI models enough fuel to be able to achieve the targets of your use cases.
Okay, excellent. And just as a final couple of questions here, looking to the future, how do you see AI impacting the mining sector in, say, the next 5 to 10 years?
That's a very good question. And honestly, it will be a bit challenging for me to make predictions about AI technology. And the reason is that it is evolving so rapidly that no one actually knows how the next months will look like. So what I can say is that as mining professionals become more familiar with the mass consumer AI products like ChatGPT or Gemini or Copilot, their ability to communicate with machines will improve. And that would in turn make it easier for them to start incorporating AI into their day-to-day work. So that's one thing. Now, for companies, it will actually allow them in a very similar way. And as their organizations get used to AI, it allows them to be better prepared to implement AI solutions. And the technology itself, I mean, we see it improving every day. So Whether we're talking about predictive AI or generative AI or any other form of AI, it will be increasingly accessible, more understood by the mining industry, and therefore this will make much bigger impact on the industry.
Okay, excellent. And just as a little follow-up here, is there any area in the mining sector that you think the impact will be particularly profound, or is it still open?
That's a very good question. But I think that the AI technology in general will become much more mainstream in the industry. So I think it will impact the overall value chain of the mining sector. To me, today's AI advancements are very similar to what happened in the late 90s with the dot-com bubble, or what happened with the first and second industrial revolution. So you cannot say it's going to impact one areas and not others. It's going to impact all the areas with different levels, but it will be there. And as we're using, for example, emails today to communicate, in the upcoming years, AI will be as democratized as any technology that we are using today on a daily basis.
Okay, excellent. So if people want to learn more, where can they find you online? Is there a website? How do people reach out if they are interested in pursuing this?
So they can definitely reach us on our website, which is ai.energy, or on ai.energy LinkedIn. So they can definitely find us there and just send us a message and we will get back to you.
Mariem Akrout, CEO of AI Energy, thank you for joining us and sharing your perspective on this week's Northern Miner podcast. Thank you once again to SRK Consulting for sponsoring this week's episode of the Northern Miner podcast. You can find them at srk.com. And thank you also to Mariem Akrout for expanding our understanding of AI and how it can impact the natural resource industries. And thank you, dear listener, for joining us once again on this podcast. I really hope you enjoy the show. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week,